Okay. So last week we talked about there was two things that you needed to learn how to do that were of most priority as a trainee. Can anybody tell me or remind me what those two were? Okay. One of them was learning how to invite. You have to know how to invite somebody to a policy review. All right. And it's very simple. You basically say, hi, this is me, whoever you are. Hi, this is me. I am studying to get my public adjuster's license, and I need to review 3 to 5 insurance policies as part of my training. Could I count on you for one of them? That's it. Now, you need to do that. How many times? I don't know. We need to do 3 to 5 insurance policy reviews at a minimum in order to get three training claims done. And we need to do at least 3 training claims. So maybe you need to do it 5, 7 times, maybe 10 times. But that's a key skill that you need to do. We can help you with it. Robert, Les, Mike, Maria, myself, Renee, we're more than happy to help you do it and do it on a 3-way call. Okay. So that you basically say, let me use Les. Okay. Les, hi, it's Paul Peck here. Listen, I have my trainer on the phone. I'm learning to become a public adjuster. I'd like to turn the call over to Maria for just a second. Hi, Les, this is Maria. Listen, Les is learning how to become a public adjuster, and she needs to look at 3 to 5 insurance policies in order to learn how to read those policies. She mentioned that you might be one person that she could count on for being able to look at that policy. Would you be willing to help her out in her training? You see, that's a 3-way call. All right. I didn't even make, Maria didn't even make me do it. Maria made the call for me because she was my trainer. Okay. So all I had to do was introduce her, and then she was able to set the appointment. So you need to develop that skill. That is the first skill, and that is the first thing that you need to do in order to make money in this business. If you can do that, we'll do everything else. We'll do the presentation. We'll do the inspection. We'll write the claim. Okay. But you have to help get that introduction done. You have to do that invite. It's just the way it is. And then after you've done that a couple of times, then hopefully you're going to be in a position where you now feel comfortable in doing a little bit more. And then you'll do more. And then you'll do more. And then pretty soon you'll be able to do the whole thing by yourself. We're not trying to throw you out into the wolves. We're not trying to throw you out into 20-foot water and have you learn how to swim in 20-foot water. That's not the way this business works. That's not the way I work. But you got to start. And the way you start is by doing an invitation. Okay. The second skill you've got to learn is you've got to learn how to take a test. So you got to be like Tackle, and you got to take that test. Okay.
You live in Ohio.
Well, sooner or later, you're going to have to take the test even in Ohio or California, but not right away. So those are the two things that you need to learn. And of the two, learning how to invite is the most important. Why? Because it gets you money. Okay. Once you have the money, then you can use the money to get the exam done. So you got to learn how to invite. So now once you've invited and now we are doing a policy review, what are you going to do in the policy review? So what I want to do is I want to go through some of the key things that I try to bring about and talk about when I'm talking with a client. The first slide is basically an opportunity for you to say, listen, I'm not trying to sell you anything. I have nothing to sell. Your Your pocketbook, your wallet can be left upstairs. We're never going to try to sell you anything. I never have anything to sell you. What I want to do is make sure that you're protected based upon your insurance policy, and that you have a policy that is going to do for you what you anticipate it doing, that it's the right policy for you. And then this slide is to help develop your credibility and to help have the homeowner think that, oh my gosh, I really don't know everything I thought I knew about this policy. Because there aren't a lot of homeowners that can answer these questions. I don't go through every question. This whole presentation should probably be somewhere around 20 minutes. Now, any of you that have done one with me know that I go long. Mike, you're already laughing, and that's not fair.
You and me both.
I take a little bit longer, okay? Because I don't know how to not talk. But a lot of you guys are much better about that than me. So you should be able to do this in 15 or 20 minutes. It normally takes me about half an hour. Okay, half an hour to maybe a little bit more.
Listen, I'm trying to be better with it too, because I feel like I can be talkative, but I also want to add a lot of color to it, which I think is valuable. But the more color I add,
the longer it goes.
Just like stories, the more stories you tell people, the longer these goes. But those stories are important. That's your credibility.
It is.
Yeah, and I think sometimes you have to feel out the client, because I've had at least one person that I could tell was like, are we going to get this over with? You know what I mean? And so you have to use your sixth sense too.
So if you're only going to do one thing on this slide, you're going to enter them, right? You're bringing them in.
It's done.
It's that middle question. What is your deductible? Most people don't understand the deductible. And so I want to make sure people understand the deductible. So I'll let people know you always compare it with an automobile deductible. Okay. Now, for those of you who don't know, an automobile deductible, what happens is you bring your car to a body shop and then you pay your deductible in order to get your car back. So it's actual money out of your pocket. With a homeowner's insurance policy, it's not. It is an amount deducted from the total amount the insurance company pays you. So if you have a $5,000 claim and you have a $1,000 deductible, the insurance company writes you a check for $4,000. $5,000 minus the deductible equals a $4,000 check. So you have no money coming out of your pocket at this point. It's $4,000 that's going into your pocket. Now, what you do with that is up to you. Unlike the automobile, you now have control of the money. These are concepts that most people do not know, and yet it's valuable to them, because a lot of people don't file claims because they don't have the $1,500 or the $1,000 required as part of the deposit or the deductible, because they think they actually have to have that coming out of their pocket. They don't. That's the most important part of this slide. If you want to go into other things, again, if you've got a story that you can add to it, or if you feel that your client needs to know something else about it, like a lot of people are worried about the question right below that one, and you can make sure people know that your insurance premium is not going to be increased because of one claim, that their premium is based on the fact that they're going to have 2 to 3 claims every 5 years. That's part of the actuarial table. So that's kind of built into their premium. So you can let people know about that.
A what table?
Actuarial table.
Who knows what that is on this call?
Probably nobody.
So why don't you explain it to them, Paul?
So an actuarial table is, okay, everybody sees the picture of Winston, right? Does Winston look older or younger than me? Okay.
Well, maybe he dyes his hair.
Oh, could be. So Winston and I go into our friendly insurance company and we ask for $1 million in life insurance. Do you think we're going to pay the same rate? No. Do you think they're going to charge me a lot for that $1 million of life insurance? Yeah. Why? Because my chances of dying are greater than his. Okay. So there's an actual table that insurance companies have built based upon different pieces of evidence. So in other words, you have this much of a chance of dying if you're 65 years old. You have this much more of a chance of dying if you're 65 years old and have had a major heart attack. You're this much more, and so that's called an actuarial table, the table that defines the differences in risk based upon different issues. Okay. So the opportunity for a home to be robbed in New Jersey is greater than the opportunity for it to be robbed in, let's say, Oklahoma. Okay. So the home insurance policy is going to be lower in Oklahoma than it is in New Jersey. That makes sense, right? That's an actuarial table. Okay. That's part of an actuarial table. Thank you for that digression so that I would go really, really long, Robert. Thanks so much.
Well, you're throwing out terms. Our people need to know what the terms are because we need to sound professional when we talk to our clients.
That is a way. I will tell you that is a great term to use because a lot of people don't know it. And if you can explain it, almost,
I
not
was
quite.
actually surprised about that term because I have my life insurance license and I've never heard that used before.
Really?
Yeah, that was news to me. So
Do you
this
know
is all.
There's actually
What was that?
people in the life insurance company that are their job title is actuarial.
Huh.
That's their total job.
Actuarialist. Yeah.
They refer to it as a rated risk whenever they spoke to me about it. I'd never actually heard that term itself.
Well, actuarial, that's what, 4 or 5 syllables. And, yours was all one syllable words. So
we're not going to ask Paul without cheating to spell that.
Yeah, please. This one is one of those slides where you just, let people read it. Here we start developing why a public adjuster. And we're an advocate. We're somebody who's going to help the homeowner or the business owner. And I always use that second bullet. I almost say verbatim every time I do a policy review. We work through professional representation. We make sure the insurance companies treat you fairly and, most importantly, pay you fairly. Okay. Those are great words. Memorize that because that really is the guts of what we are doing. In the example, if you want to read this initially, feel free. Okay. These slides are built in such a way that all you have to do is really read them and you can go through them. Now, I don't read a single one of them, but that's because I've been doing them for 7 years. So feel free to read the slide. The big thing here is making sure people understand that this is the way that the insurance company does not have any responsibility to tell you what's broken. Okay. They have no responsibility to do it. So they're only going to fix what you tell them is broken. We, on the other hand, have a responsibility to our homeowner to make sure that everything that needs repair is addressed. Okay. Now, we never actually tell them we're going to fix it because we don't. We're not contractors. What we want to do is we want to make sure everything is, and this is another important word, addressed. Okay. So if you don't have this slide again in your deck, and Robert, you might not, If you don't and you want it, let me know. I'll hand it. I'll get it to you. But I think this is the right way of putting this slide out there. And the way the company has it is, do you want A or B? Duh, I want B. But the big question is, why is there an A or a B? And the reason is because the insurance company wants to pay you A, but they should be paying you B. Okay. And that's really the net of this. On this slide, again, this is one that you can read. 80% of homeowners accept the damage appraisal, accept whatever the insurance company says is wrong. And because of that, they only get 25 cents on the dollar. I never say the 40 cents, they can read it. I say the 25 cents because it makes a bigger impact. Does that make sense? Now, on this one, this is a tricky slide because if you look, this one talks about cents, dollars and cents, 25 cents on the dollar. This one starts talking about percentages. So what I want to do for you is I want to put this into dollars and cents. A difference of 600% means 17 cents on the dollar. Okay. So I think it's important to let people know that if they don't work with a public adjuster, it's likely that they're going to get 17 to 25 cents on the dollar. Now, somebody's going to say, I can't imagine accepting that. There's no way I would only accept 17 cents on the dollar. And the answer to that is, you don't even know what a dollar looks like because the insurance company never tells you what the dollar is. Okay. Remember, they're only showing you and doing what you've told them is wrong, which is a small portion of what needs to be repaired. So if you think A is the full dollar, then they're paying you for a full dollar, aren't they? Because you never know that B exists. Once you know B exists, now you know you're only getting paid 25 cents or 17 cents on the dollar. Does that make sense to everybody? I want to make sure because this is critical when we start talking about our fee. You've got to set the stage properly so people understand if they do it on their own, they're going to get screwed. They have to understand that. This is called a settlement reopen or a settlement review. And we have the right with our license to reopen a claim that's already been closed and make sure that if somebody only got 17 cents on a dollar, that they get that full dollar. So you can take the previous slides and use those slides to then talk to, here's some real life cases where people were given 17 to 25 cents on the dollar or less. Sometimes they were denied. And we were able to reopen that claim and get them the full dollar. We handle, I always on this slide talk about the 10,000 claims per year. John Mesco talks about 1 million clients. That's a valid thing to talk to as well. They're going to read on this slide the 99% satisfaction rating. So that's great too. And then I just reaffirm that we do both residential and commercial. So now that we've kind of set the stage as to what a public adjuster does and what the insurance companies don't do, now let's set this. Now what we're going to do is talk about insurance policies from a generic perspective. And we're doing this because then we're going to talk about it from the specifics of their policy. So what we do here is we start going through the 16 perils. All right. So fire, it doesn't have to be catastrophic. I always say that about fire and smoke because the pictures look pretty catastrophic. but it doesn't have to be that. It could mean just an ember popping out of a fireplace and burning a hole in the carpet. That's an insurable loss. Okay. We're coming up on Thanksgiving. I guarantee you somebody's going to overcook their turkey. That's an insurable loss. Lightning and explosions are both sudden and accidental events. So wind, any wind damage is a loss, is an insurable loss. Anytime rain enters the home, it has the potential of causing damage in the house. These are things I say. Ice and snow, burglary, hail, tornadoes, hurricanes. I just run through these because, again, it can get awfully long. This is one that I kind of reactivate the client with. And how I do that is and you guys have heard me do it, some of you. Flood events. These are accidental discharges of water. Okay. That's what a toilet overflow is. That's what happens when the washing machine malfunctions or the dishwasher malfunctions. These are accidental discharges of water, and they're covered by your insurance. By the way, I think this is the biggest, isn't it? The biggest claim area that we have.
I think it's top two between when you look up for the damage, you look down for the money. So water damage does carry a lot. Even a little bit of water damage. If you get a house that has continuous flooring on that first floor, a homeowner goes from thinking it's only a couple $100s to getting paid out $15,000 to $18,000 for that little damage.
Yeah, I have that issue going on with Letitia. Letitia had a toilet overflow, damaged very slightly some vinyl planking in her bedroom, but that vinyl planking in her bedroom goes all the way throughout her entire first floor. So we're working, she just gave me the receipt on her flooring so that now we can get it priced and the insurance company will pay for the entire first floor to be redone. Because it's vinyl planking, you can't just, you just can't pick up one piece and call it a day, right?
Right.
So
yeah, those are one of the claims when I first had that happen next to somebody's toilet. I mean, I had a hard time containing my excitement.
those can be very good claims. So accidental discharge of water, what Abahi said is really important. She said something very, very important. What was that about looking up and looking down? Do you remember what she said? What'd she say?
Look up for the damage, look down for the money.
For the money. Yep. What she's saying there is the floors are where the money is. It's very expensive to replace and to repair flooring. So you're going to find damage sometimes from above. What you want to do is see that it damaged something down below. Okay. Theft and vandalism is covered. By the way, these can be big claims as well. So one of the things I do, and I've done it with you guys, is I look at that first picture on the left, and I always ask, so can anybody tell me in what ways is that hardwood floor going to be damaged because of that picture? And there's at least
liquid,
three different
got heels.
So the heels, a woman's heels puts 10,000 pounds of pressure on the hardwood floor, which is enough to dimple the hardwood floor. So that's enough for a refinish or sometimes a replacement. What else? Somebody else.
The water.
The water is going to decompress the wood. In other words, it's going to raise it up a little bit. And that will cause damage as well. So that's the second one.
Glass.
The glass is going to scratch the hardwood floor. That's the third. Good, Mark. Well done. So that one picture shows three different ways that hardwood floor can get damaged. The middle picture, and again, I'm going to use, so we talked about in that picture that water decompresses the hardwood floor. Okay. Does everybody understand what that means? It means the water makes the wood expand. Okay. And that's called decompression. Does anybody know what the damage is in the middle picture? What do we call that?
Delamination.
Delamination. That's what that's called. That's when the water separates. In other words, it erodes the glue that holds the backing onto the carpet. And that's called delamination. Okay. These are good terms for you to know because they make you sound really impressive. Okay. So the middle picture is delamination. The picture on the right is delamination as well. That's where the water has gotten into the vinyl floor and has delaminated the vinyl floor. Okay. Then this one is where, you talk about silly, stupid stuff happens in a house, you live in it. So some of those things that happen are actually claims. So your kids running up the stairs and pulling the chair or the stair rail off the wall, that's an insurable loss.
Potential to be an insurable loss.
No, if the kids did it, it's absolutely an insurable loss because kids can't have intent. So anything they do is an accident. So your kid wants to put his hand through the wall and he does it. He's successful. It's still an insurable loss because he's not of majority. It makes it harder for us to get, but that's not, that's the way the state looks at it. We then go in and talk about, us. We want to edify the business that we work with. We are the largest public adjusting company in the country. We are the only one that works on a national level the way we do. We are vet owned, which means a lot to some people. And that's an important thing to bring out. And then this AAPIA, I talk about this as an advocacy group for our clients as well as for public adjusters. Because if it's only for public adjusters, they don't recognize the fact that we're really looking out for their interests. But this group actually is looking out for the interests of the homeowner by also looking out for the interests of the public adjuster. This slide oftentimes gets kind of pushed over, but I go through each charity. Every time we settle a claim, we send a net to Africa, protecting kids from malaria. And we also plant a tree. Every summer we do a golf outing, except for during COVID. We typically provide, on an annual basis, we provide money to Operation Enduring Warrior. And then I spend a little bit more time on Feeding America. I talk about the fact that if you, Mr. or Ms. Client, provide my associate with additional names of people that could benefit from the information we've provided you, we will feed somebody in this area in your name. For every person that you provide, my associate will feed somebody. People like that. People like that. So that's a nice way of also helping to get referrals. I reiterate the fact that we have an A+ rating with the Better Business Bureau, and we're licensed in, actually it's now up to 48 states. All right. There's 2 states that don't. If you get asked what states they are, I believe it's Alaska and Arkansas. It's either Arkansas or Alabama.
I've got Alaska, Alabama, and Louisiana as the blackout states.
Okay, that sounds good too. We don't do business in the Gulf states, just so that you know. Texas, Louisiana, Alabama, Arkansas, Florida. We just can't do business there. Mississippi. It just isn't worth it to do business there. So we don't. The closest we get is really Georgia and South Carolina, because we don't do business in Tennessee either. So Kentucky is a great state. West Virginia is a great state. Virginia, North Carolina, South Carolina, Georgia, all are great states to do business in. Now we tell people about our fee. And this is where I go back to those other slides, those original slides. Remember I said that if you tried to handle this claim on your own, you're going to get 17 cents to 25 cents on the dollar. If you work with me, you get the full dollar, but we have to get paid. So on a small claim, we're going to get paid 35% of the claim, which means you're going to end up with 65 cents of the dollar instead of 17 cents. So you're making 3 to 4 times the compensation you would have gotten had you tried to do it alone, even after our fee is paid out of the proceeds. You don't have to pay our fee. It'll be paid out of the proceeds. On a large loss, it's 10%. So we reduce our fee based upon the size of the claim. And we do not charge the client unless we get you paid, nor do we take a fee on the deductible. So this is how I go through that slide. I don't do too much more than that. I don't spend too much more time on that than that.
Mr. Paul, I'm sorry. I have a question.
Sure.
The company where I was working, as I told you before, a claim specialist, we charge the deductible. We charge the deductible in every one of the customers.
Yeah.
So in this case, according to that you training in the first area, you say the customer received the deductible payment to the insurance in the check that they are going to receive it. In other words, the customer is going to receive his check and the insurance already is going to minimize the deductible. In
That's
another
correct.
word, for the customer in his imagine, he's not pay nothing. He's going to be free.
Yeah.
Because this is the attraction for the customers. In the area that
Absolutely.
I live it is, oh, you are going to repair and I have to pay nothing? Where can I sign? That's the first thing that I say.
It's great.
Okay, I get it now.
You got it. Anybody
So,
else have a
Paul-
question on this?
Yeah, I
Abahi?
was gonna just ask if you can go through that slide again, like if you came up to this, sounded pretty good, and I know that cost and pricing is an objection that people get often.
So on these slides, I go through very specifically that this is 25 cents on the dollar. And this one, I make sure people understand what 600% is. 600% means you're getting 17 cents on the dollar. Okay. So in one study, it shows 25 cents on the dollar. Another one, it's 17 cents on the dollar. Now we go to this slide and I talk to the fact of when you work with us, you get the full dollar. However, we do have to get paid. So we're going to take 35 cents from that dollar and you're going to get 65 cents. So what that means is you're getting 3, maybe even 4 times the compensation you would have gotten had you tried to handle this claim on your own, even after our fee is covered out of the proceeds of the claim. Does that clear it up a little bit, Abahi?
Yeah, I think it's wonderful how you say it. I think it's wonderful.
I thought it was interesting. John had never heard it this way. And I think it's a tremendous way of proving our value without having it cost the client anything out of their pocket. When we say there's no money coming out of your pocket, we literally mean that. You're going to get more money by working with us on a good claim than you would trying to do it on your own, even after our fee is paid. All right. So that's the way a policy review should go on. And then you ask for the referrals. So the biggest question here at the end, I always ask, so what did you learn today? What was new for you today? And
Water is no water.
Exactly. So
And the deductible.
So do you think that you know of somebody else who could benefit from the same information? That's what we would like to provide them with this information as well. So if you could provide Mike with their name and telephone number, we can reach out to them and make sure your friends don't get sideswiped by the insurance companies, just as you now will not be taken advantage of either. And that is a policy review, guys.